In this video, I'm going to tell you how to plan for a recession. If you're working on finding money from investors and to raise money for your business so you can acquire other people's businesses, and for whatever reason, I'm going to tell you all the things that you should watch during a recession. And you want to make sure that you stick to the end, because the third tip is going to make sense in the context of the whole video. So the first thing that you want to do if you're working on raising money and it's a recession, or you're worried that there's a recession, is you want to make sure that, based on the tons of clients that we served, as a person, I run a company called Raises.com, where we raised, tens of millions of dollars for hundreds of people at a time. The key thing is to make sure that the investor is de-risked. So it's remove the risk. And a way that you can remove the risk is to make sure that you look at all parts of your deal that benefits you, and the investor has upfront risks to take, and just remove those parts. For example, if somebody's raising money to buy real estate and they have something called a management fee, which means that regardless of how much money they make for the investors, they take a percent of the fee, like a percent of all the money that is invested. Let's say somebody invests $1 million, they would charge 2% management fee, meaning that they will take $20,000 in fees from that investor that invests $1 million. There's a risk that, there's a guaranteed risk of losing that money. For a 100% chance, you're going to lose $20,000 if you invest $1 million. You're not guaranteed on how much money you're going to make. So what people do is remove management fees when there's a lot of skepticism, when there's a lot of competition, and when the market isn't doing that well. And so you can remove management fees to make sure that your investors feel more comfortable, so that they don't lose money, and there's a 0% chance of them losing money. Another thing you can do is just lower the performance fees. So, if you want to make sure that investors feel de-risked, just lower the amount of money that you take from them in general. So one way is removing money that you take from them without them making money back. But if you make money for an investor, let's say you say, hey, for every $1 I make you, I take 30 cents. Just say, hey, for every $1 I make you, I only take 20 cents. And so that's something called the performance fee. And if people invest with you, something that's really easy to sell is, I only make money when you make money. But then if it's a case of them not making money, when you make money, if they're making money when you make money, just make them lose less money. And that will lower the risk. And then the third thing is the experience, because sometimes when you work on raising money for a specific type of deal, if you don't have as much experience as needed to be able to raise money for that type of setup, let's say you want to buy more real estate and do fix and flip, but you don't have as much experience doing fix and flip, then what you want to do is, simply put, do the types of deals that aren't related to, that are super related to fix and flip. So if you buy real estate and then you fix it up, you fix up the cabinets and all that stuff, and then you sell it, just do things that you're experienced in doing and raise money to do more of that. But then if you take something that you know how to do and then you ignore it and then you raise money for something else, let's say you want to raise money to buy a bunch of farms, but you've never done anything with a farm in your life, the risk will be really highly perceived. So why would you risk an investor's money on something that you don't have experience doing? So stacking on that experience and focusing on that core demographic of people with experience can really make it really strong. Another thing, this is kind of a bonus, is the idea of debt. Because typically, some people see debt as a risk, because the issue with debt is you're getting a loan to do something. You're getting leverage. The issue is the more debt you get, the more money you can make, and the more money you can lose. So some people perceive debt as a risk. So if you want to prevent investors from feeling like they're taking a lot of risk, just make sure that there's more money in the projects and there's less of a loan, that there are less loans that are taken from other people. There's less debt. In general, debt can be seen as potentially risky in many cases. So, unless you're the one who is making money from debt, then it can be seen as risky if you're asking investors to invest into a deal that is 99% lended out to other people, and you put in 1% of the down payment for that. So in other words, to keep it real simple, let's say that I'm raising money to buy an apartment, and I've gotten loans from people that have lent out most of the value of the apartment. The apartment costs $10 million. I got a loan for $9 million. So I'm raising $1 million. The issue is, the more debt there is, the more chance that it can actually default. Like, it's possible that the interest payments on that debt will be too high for me to pay back. But if it was all equity, and if it was something that I owned, like let's say I owned $9 million, I had $9 million to put into the thing I want to buy, and I'm just raising $1 million, then I'm not taking on any risk from a lender that is coming after me. I have all the money to do it myself, and there's less risk. And when you have a lot of debt, you're subject to interest rates, so you have to pay back the interest from the lender that lends you the money. But the interest rates may change depending on the deal. Sometimes the interest rates are stable, in other words, fixed, and sometimes they're variable. In other words, they change based on the market conditions. But why take on debt if it's perceived as a risk? And so these are the things you can look at. All right. So, you really want to make sure that, and then the last thing is probably, you want to be in touch with the trends. So right now, at the recording of this video, there's a lot of trade war talk between US and the world, and Canada, China, and the rest of the world. So if you're buying a business or raising money to buy real estate that is affected by the trade war, then it will be considered more quote-unquote risky. So for example, if you're raising money to buy a business that does 80% of its trade with Canada, then the amount of money, that the profit that company will make will probably go down, because tariffs are going to cause the price of goods to, like the price that customers have to pay for the goods to go up. And so because of that, you're going to have a lot of trouble dealing with, making people feel as if they're comfortable, feel more comfortable. And these are some of the things you have to think. So in a nutshell, make sure that when you're working on de-risking investors, or when you're working on raising money during a recession, you want to make investors feel comfortable. And you make them feel comfortable by removing all the perceived risk in a deal. And you can do that by, just removing the risk, by focusing on what you have experience in, by removing debts, by focusing on trends, by making sure that you structure the deal so that the investor benefits without any upfront risk that they take. And so if this is something that you'd like to do when you're working on raising money, so that you don't have to make investors feel stressed, take a look at it, book in a custom one-on-one consultation with Raises.com for free, where either myself or one of my teammates will go through your situation step by step and take a look to see if there's something about your situation that we can help you, maybe there's something missing, and sometimes it takes an external perspective